Welcome, and thank you everyone for tuning into our latest Economic Outlook report with a focus on leading indicators most impacted by COVID-19. This conversation is taking place on Monday, April 6th, 2020. Please welcome Prevadary's Chief Economist, Andrew Duguay. Thank you for taking a moment to join us. Andrew, I know you have a hectic schedule. We appreciate you sharing your thoughts on the rapidly developing economic challenges resulting from this health crisis.
Thank you, Nicole. And as we talk about the economic outlook, of course, we want to recognize the severity of just the health crisis in itself. There's been a lot of, obviously, commentary on the economic outlook provided by Prevadary and others, but we do want to take some recognition of the fact that the health crisis is far more important. And as we try to analyze the economic outlook, we are in no way trying to downplay the severity of the health crisis. That being said, I myself and a lot of other economists and financial analysts are not health experts. And so we refrain from trying to make judgments on what is the best policy to fix the health crisis or when that health crisis is going to subside. For that, we really depend heavily on medical experts and World Health Organization and the CDC and others to make that type of analysis. But given the health crisis situation we're in, there are obviously economic consequences to that, and that is what we want to talk about and dialogue about today and help, again, give some context. Certainly, economic outlooks at a time like this are very uncertain, but as we talk with each other from week to week, we want to bring up what's on our minds as an economist team who are looking at hundreds and thousands of data sets to try to make sense of this unprecedented situation. So I'm going to start with a familiar slide, and this is the number of confirmed cases since the 100th confirmed case. We've shown this before because I think it provides some great context for where the United States sits here today as we're going through what could be some of the worst weeks in terms of number of new cases as well as potentially deaths in the United States. Now, this isn't something that hasn't been experienced already in other parts of the world. As we know, this crisis started in Asia and then quickly shifted over to Europe, now North America, and we're even seeing some side effects in emerging markets that are very concerning. When we look at the number of new cases, we can see that the US has elevated to the top of the scale with the total number of confirmed cases larger than any other country. The key goal, obviously, is to bend this curve and see a stop in the exponential growth in new cases that had been going on since the early days. However, we have long talked about one of the key questions, and something that our team gets asked frequently is, hey, can we use the lead time from Asia and then even possibly Europe with a shorter lead time to mimic what is going to go on in the United States from an economic crisis perspective? We know that a lot of traditional leading indicators that often signal recessions 1, 2, 3 quarters out in advance were essentially thrown out the window with this crisis because of the shock factor and the suddenness of this economic downturn, which felt like a light being switched from on to off, right, with the US economy humming along with relatively strong GDP growth and consumer spending right up until we were all told to shelter in place and practice social distancing and close non-essential businesses, which ultimately flips the economy upside down and essentially sends the economy into recession. So we didn't have any traditional leading indicators for this crisis, but could we use the timing of other countries to predict what the rebound looks like? And of course, the use case that gets talked about most is China. And that's what we want to talk about a little bit today, is can we use China as a use case for the United States? And unfortunately, the simple answer would be that yes, we can use China as leading indicator, and therefore we can predict just how bad the things are going to be at their worst, but importantly, what the recovery is going to look like on the backside. I think in reality, the answer is much more complex. And let's talk about the reasons why. So in studying the Chinese economic contraction as well as the recovery, we say, okay, well, what data do we point to in China that we can say is mimicked across other countries that saw a pandemic breakout after China? Well, there's some measures, some health metrics that we could look at, and the obvious ones would be looking at the total number of cases per million and looking at that in China compared to other countries. We can also talk about, hey, what were the days in between the initial spread and then the total peak in new cases? Now, there's been some talk that perhaps the US is reaching its peak, single day peak in new cases. And when we look at what that potential peak was, we see that the peak in new cases possibly was April 5th because the number of new cases went down after that for one day, but we still don't know. It's still very early. What we can learn is that the gap between China, which we're showing here in a neutral color, and then what we compare it against other countries, is that it's probably not the best metric, right? If we look at the initial days between the initial spread and the peak number of new cases, Italy and Germany also saw a similar mid to high 20s in the number of days between the initial spread and the peak number of cases. However, it's really about the pace of those new cases that really matter and send the Italian economy crippling, and Germany not far behind. If we look for other metrics, we see that Korea managed to see a peak in new cases 8 days after the total number of cases surpassed 100, which is quite impressive. However, if we look down at the total number of cases per million or its exposure to global trade or the currency threat, we see that Korea has multiple facets of its economy which continue to be threatened despite the fact that it was an early mover on the health crisis, did lots of testing compared to other countries, and managed to get the peak number of cases within 8 days of the initial spread surpassing 100. So that's probably not the best metric. When we also look at cases per million, when we total number of cumulative cases, we see that China, it was about 57 per million, and we see that most countries have long surpassed that, including the US, where it's about 943 cases per million. So the interesting thing to note here is that in China, where it started, there was a large economic fallout from the event with everyone sheltering in place, even though the cases per million are much lower than what we're seeing in other countries now. When we think about economic ramifications, it's really the shelter in place policy that matters more, and the fact that people have to stay away from each other in order to get to containment at any sort of level of cases per million. So it's not necessarily the cases per million that matters, but it's really the fallout from the social policies that need to be mandated in order to curb or flatten the curve, if you will. So in reality, it's not a very good metric to compare against. When we think about other metrics from China and into other countries, we think about increasingly that this is turning into an economic crisis all its own, separate from the health crisis. And so this means a fallout from oil countries. And so I included Russia in here because you can see relatively low number of cases of COVID-19. However, its exposure to global trade is much higher than China's at 52% of GDP. And its currency has been much more threatened than China's. And the economic fallout from just these two events, regardless of a health crisis, are going to be much more severe. Now, of course, Russia and other countries are also imposing some shelter-in-place policies, which will have negative economic consequences, but we have to think about what are the economic consequences aside from the number of new health cases, and they're pretty severe in many countries. And last week we talked about emerging markets not only getting exposed to the health crisis, but already seeing the dire consequences of the economic fallout from their exposure to global trade and the weakness of their currencies. So I think the lessons learned from this is that there's not really any case of a comparable country quite like China when it comes to enough similarities to say that the economic recovery is going to be mirrored. So unfortunately, when we want to look at the recovery in China, we're going to have a lot of caveats to that recovery to say, well, it could apply to Italy if this was the case or that was the case, right? When we look at the severity in Italy, the health crisis is much more severe. They also have a larger exposure to global trade. Things will be worse. And then when we look at Korea, the health crisis is not as severe, but by their early containment measures. However, the economic crisis, they're going to be faced much larger challenges based off of currency and exposure to global trade. In the US, we do have favorable conditions when it comes to our low exposure to global trade, and the fact that the dollar is a safe haven, so we've seen even stronger dollar growth against our trade partners than China has seen. However, the health crisis has drawn on for much longer. We've been exposed to it for more days, and there are more days to come ahead, which could drag on the economic crisis.
Andrew, this seems like a good time to ask a quick question here. Looking at the slide, the declining currency in Russia looks significant, and I'm wondering if you could add a few words on impact possibly felt here in the United States and perhaps more widely global.
Yeah, the financial unraveling due to this coronavirus has really shown in different ways, and that's why I wanted to show a currency threat, because a lot of economies that have seen less of a health crisis are facing significant currency crises, and including Russia, where we're seeing obviously drastic decline. Now, a lot of this, as we know, has to do with the fact that oil prices have fallen so significantly, and that has negative ramifications for Russia as an economy and as a trading partner. However, I think we need to think about the fact that, while we might be having conversations in the US and Europe about long periods of deflation and how do you stimulate consumer spending during a deflationary crisis, a lot of other countries are really going to be seeing the opposite. This is a huge threat to inflation in Russia, the fact that your currency loses almost 20% in just 3 months. And we're seeing a lot of other emerging markets or oil-heavy markets or commodity-driven markets, even like Chile, see significant hits to their currency, which is going to have inflationary impacts and threaten a lot of the economic systems put in place that rely on stable exchange rates in order to see economic gains. So in summary, I think what this means is that there's no one silver bullet indicator to look at for comparison or a leading indicator coming out of China to compare to our own economic conditions as we look to the second half of the year. What we are seeing in consistency is that the economic pain is consistent across both manufacturing and services. When we want to look for global indicators, these purchasing managers indices have gotten a lot of headline news, and that's for a reason. They're valuable leading indicators that tend to come out on the early side of every month. For data for the month previous, this is a lot earlier than a lot of government statistics that come out. And you can compare across countries. So the key things to know about these purchasing managers index, they come from multiple sources, but IHS Markit, as well as Institute Supply Management here in the US. But the thing to know about these purchasing managers index is that they're a diffusion index, and really below 50 means contraction. And so when we've been watching for these releases, what we saw in China particularly is that both manufacturing and services saw very strong declines, really the lowest on record, essentially, going back several decades in February as the economy shut down. Now we have early indications, and that's from March data, which said, hey, things are still relatively bad, especially by China standards, to see manufacturing in a neutral position or services below 50. However, and so a lot of these are the second worst readings. However, March has improved from February, and this would make sense, right? As the US moves through its health crisis and our shelter-in-place policies eventually get lifted. That may be next month, right? I try to refrain from giving timings on that, but when it does pull back, there are people who are going to be able to go back to work, and we will start to see economic indicators start to move up from crisis mode. But I think what we're probably going to learn from this, and as we watch data from China, it's about that relative recovery. Are things really going to get back to, quote, normal? Or are things really going to look like, hey, better than the crisis, but nowhere near pre-crisis levels? And I think that's really what we're going to probably be exposed to as we watch China move through its recovery, and these other countries also move through the crisis. As you're seeing right now, these March numbers are all either early crisis or mid-crisis, depending on what country you are outside of China. That the numbers are going to improve. They're going to have to. Most of them are at either record lows or the worst numbers since the global financial crisis, or in the case of Japan, the tsunami. These are not good numbers, right? But we will see that because a lot of this economic crisis is melded with the health crisis, is that once those restrictions get pulled, you will see some recovery numbers. However, we do think that there's going to be a high likelihood that you're not going to see these numbers get back up to pre-recession levels anytime soon. And when we say anytime soon, that's going to probably be multiple quarters out into the future. We think that global growth is going to be suppressed in the second half of the year. So I think some summaries to make to these points as we wrap up is, can we use China as a leading indicator? I'd say directionally, perhaps, right? If it goes through a crisis and then it comes out of a crisis with some pretty bad numbers, but not as bad as during the crisis, yes, the US and Germany and others will follow that pattern. I think we probably could come to those conclusions without looking at China's data either way, right? I think it just makes fundamental sense. But what are the challenges is using China as a leading indicator? I think this is where it makes things rather complicated looking at China. Is one, the data quality out of China is challenging at times. We have a mix of public and private sources. Obviously, the information coming out of China is more restricted than in other countries. And so we really have to be careful about data quality checks when we're trying to get real statistical measurements coming out of China. The second thing is that China is still in that quasi-emerging market status. This makes it very hard to compare against developed nations such as in Europe or the US economy, where China, when we look at total retail sales, they were seeing online sales growth between 15, 20% year on year steadily leading up to this crisis. So when you see online sales reduced down to a lower number, say 3% year-over-year growth, that's a drastic decline by Chinese standards. But however, by US standards, you probably should be expecting actual contraction, right? As a developed economy, the numbers are going to be much lower than what you're going to see out of China. So when we look for Chinese economic recovery, there might be some false positive signals if you're trying to compare to developed nations, just simply because of the economic momentum that an emerging market has versus a developed economy. So you're going to have to knock down those expectations a little bit. And then the third, I think, is a big one, and it's that whether you're looking at China or the US or Europe, there's going to be different government policies and reactions, and there's different market systems that are going to be in play here. In China, I think you have to think particularly about the heavy government sector, particularly the state-owned industries that can really control employment and wages and debt levels in ways that the private sector cannot. We've always mentioned that one of the big concerns here about this economic recession turning into something much bigger would be if it turns into a financial crisis. And we've seen unprecedented actions by the US Federal Reserve to try to stop financial contagion from making this crisis any worse than it is. However, when you look at China, I think you're going to see industry by industry that there's not going to be a natural market reaction to the industrial downturn like you might see in the US or in Europe, where you have more of a quicker supply demand response because you're dealing with more private sector, market-based fundamentals. So when we look at the fact that the Chinese numbers might be skewed a little bit by the government absorption of economic pain. At the same time, when we look at stimulus packages, China's relative to the size of its economy was a little bit lower than what we're seeing in Europe or out of the US. So we might see different reactions to economies coming out of this based off of different stimulus as well. So there's a lot to think about there, but hopefully this helps put in some context that China might not be the best leading indicator for our own economies right now. When we are watching for data, we will continue to monitor all sorts of economic information to try to see domestically how our economies are going to turn around, but probably it's best to look at domestic indicators rather than looking abroad for the early signs of economic recovery.
Wow, thank you, Andrew. We appreciate the assessment on the growing global impact and looking toward relative recovery. It's nice to get a glimpse of that at last after these long, tense weeks. So that concludes this economic update for Monday, April 6, 2020. Our thoughts are with all of you and your families, as well as the many scientists and healthcare providers working on this crisis. Stay tuned for ongoing announcements and financial updates. And as usual, if you have any questions for our economists working on the evolving landscape, please feel free to contact us at any time.